Well, hello and welcome to another episode of the Lending Podcast. We are your hosts. He's Jeff Jones, and I'm John Burnham. Thank you for being with us today. And we've got an interesting topic. We're going to cover quite a bit with respect to credit and being an authorized user, being a co-signer, and just a lot of things the questions that we get about credit and different types of accounts.
Oh boy, I'm excited.
Yeah.
So we're going to get obligatory.
Obligatory.
When
you're obligated on a note.
It's a fun word that we don't use in any normal conversation, I think. But when it has to do with, a liability that you take on, a credit of some kind that is given to you, loaned to you, you signed up for, your name is on it, so you're obligated to pay it. And then what we're going to talk about is when that changes. And in real life, it's no longer your responsibility to pay it, but you're still on the paperwork.
Yeah, there's some common examples, and we're going to dive in deeper on mortgages, on car loans, on credit cards, and let's start with mortgages, because I think
that's our business.
And
for those of the people that are listening to this podcast, right? Like you and I are lenders in Austin, Texas here, and for those that are listening, we deal with this every day, right? So we're pulling credit reports and we're having to weigh those liabilities against your income. So we get your income calculation.
That's right.
And that income calculation is your buying power. So this episode is to help people understand what can restrict their buying power if they can't get taken off those things they're not paying for.
That's well said, because I would say the two most common questions we get are, how much can I qualify for?
That's
and
right.
What's your interest rate?
So this is what that podcast is about.
That's right.
But we get into the weeds of those liability lines.
Well, and little snakes in the grass that our home buyers don't realize are potential issues, right? And so let's kind of dive into what happens when you're on a note, but you're not obligated. You're not paying it on a monthly basis, but you're obligated because of the way that the loan was set up. You are a borrower. Okay, let's just use probably the most common one that we're getting right now, which is a divorce situation. Okay, so
it's a big monthly payment.
Yeah, we have a couple that they're on the note together, and then now they're going through a divorce. They're splitting up, and let's just use the example of one spouse is keeping the house. Okay, so we've gone through the divorce process. We've come to an agreement. One spouse is keeping the house. The other spouse is going to not be obligated on the note anymore. Well, we have a saying in our business that is, people separate, but credit does not.
People separate, but credit does not. That's a good one.
And what we mean by that, of course, is people can get divorced, but the credit liability does not split.
Right.
So you don't come off of the credit liability. You don't come off of the mortgage just because you went through a divorce and the judge signed the decree and says you now are not obligated on the note.
Yeah.
And so that's probably one of the most common questions we get is, how do I get my ex-spouse off the note? He or she wants to be off of the mortgage so they can go buy something else.
Right.
And the truth of the matter is, you don't need to come off the mortgage, and there's a couple ways to do it, but per the decree, if you're not obligated on the note anymore, then you're not, as far as we're concerned, you can go qualify for another property without actually having to come off of that mortgage.
That's right.
It's still going to stay on that person's credit report.
Right.
So you've got a divorce situation, someone that doesn't even own the home anymore, they're off the ownership interest of the property, but they're still on the note. They go pull their credit, and that mortgage is still showing up that their ex is paying on their previous home. And so it's just it's a challenging situation for a lot of folks, because they don't understand that there's only a couple ways to get off of a mortgage like that. You got to go through a refinance for the most part.
For the most part, and here's where you want to have a loan specialist on your side that looks at your current loan structure if you're going to go through a divorce. And here's why I say that. And most people don't think, oh my gosh, I need to talk to my lender to help me figure out a divorce decree. First of all, we're not lawyers, so we don't tell lawyers what to put on the divorce decree, but we can tell lawyers what the ramifications of obligation section of the divorce decree does for their loan. What I mean by that is the divorce decree sets the precedent of what we can do as lenders for your loan. So if it says on the divorce decree, the one person's going to basically have assumption of that property. So the mortgage assumption, that means it's going to be your responsibility. In order to show that, you need to refinance it in 30, 60, 90 days. Hopefully it's not 30, that's unrealistic, because you got to get everything together. So hopefully it gives you enough time to do that.
Yeah, usually I see 6 to 12 months even on that.
Yeah, that's true. Yeah. There are plenty of stretch. And sometimes people draft these things up, but they don't get signed for a long time.
Right.
And so hopefully that date is so far enough out, it's very doable. So you want to give yourself enough time. The refinance is the cleanest way to change people on the note. And the note is the mortgage. Title, that is different. So title is going to be basically a deed that gets, guaranteed over to you.
The deed structure.
The deed and title are different.
Yeah.
The title and the note are different documents.
That's right.
So when we deal with mortgage, we're talking about notes. So there's that. But if you're talking to an attorney that says, "Oh, you can just put a loan modification, or you can just put a mortgage assumption on there," most times that's not going to be the right language for a lender to work with.
True.
So be careful of that kind of language out there. Double check, because lawyers are not lenders, and lenders are not lawyers. So if a lawyer thinks it's easy to do something that a lender needs to do, check with the lender too before that gets ratified.
Yeah, and I think a good example of that is the court order, the court document, the divorce decree. Just because that's in place does not mean that the servicing company who you're making your payments to has to take that other spouse off of the note. They don't, because the mortgage was securitized, let's say, by these two individuals, and a lot of times it's actually two incomes, right? Both people qualified for the note, both people got the mortgage together, took out the loan in both names. Now there's only one person on the note, and you can't just take that person off necessarily. So I think the takeaway here is communicating with the servicing company. What information do they need? Is it possible to redo the loan, to remove a spouse? Perhaps the loan was qualified without both incomes. But you got to remember, these loans, there's something called the secondary market, which is post-closing, right? Behind the scenes of our business. When a mortgage closes, it's one of thousands of other mortgages that gets pooled together and then sold as a mortgage-backed security. It gets sold as a bond, and it's securitized, by the property with the collateral of the house and the promise to pay of the two people that signed that note, right? Or the deed of trust that has two people on it. So undoing that, unwinding that is really, really complex. Here's the cool thing, though. You don't really have to do that. The mortgage doesn't have to come off of that spouse's credit in order for that person to go buy something else. Because we have a decree that states whoever's staying in the home is obligated on the note. Whoever's not on the home ownership anymore per the decree is not obligated on the note. We basically cosmetically remove that mortgage from the obligations. On paper.
I'm glad you bring that up. And we understand, we talk to people that go through pretty big life changes. Divorce is sometimes one of those. And we want to make it as easy as possible for our clients, because just to even get a divorce decree finalized is probably emotionally exhausting and very time consuming and a lot of work on every angle of your life. So we don't, as a lender, we don't want to make that next step hard of executing the decisions that were in there. One of them is separating liabilities. And so all that to say is, don't just think this is going to take forever, this is horrible, I can never buy a house again. That's not true. So I'm glad you brought that up.
Yeah. I was going to dovetail off that one thing real quick.
Yeah, go ahead.
So I think the biggest challenge right now with the refinance market, let's just call it what it is, rates are higher today than they were 3, 4, 5 years ago when a lot of these homes were purchased or refinanced with two people on there.
Right.
So now you've got, let's just say, a house from 5 years ago, it was refinanced, husband and wife are on the note, or two partners are on the note together, and now they're divorcing, and refinancing that person off the note means going from a 3% mortgage to a 7% mortgage, or whatever the rates are. Bottom line is you're going backwards in rates. So we don't want folks to have to, that's not the only option, is the point. You don't have to refinance to get a spouse off the note so they can go qualify for something else.
Yeah.
And so that, I think that's a hang up right now, and it's a financial burden to refinance a note unnecessarily to a higher interest rate.
And there's other things that can happen that might help out
Sure.
with a refinance of a home. If you're doing like a cash out refinance, then maybe you might be paying off the car that is going to be yours.
That's true.
And so not only are you changing, your note rate for your home, maybe possibly to a higher rate, but you might be bringing down your car loan, basically rolling that into a cash out and saving your monthly payment there. So you might have a balancing effect if you're doing a cash out and paying off other debts that now you don't have monthly payments for.
Yeah, and that's the overall holistic view of using your mortgage as a financial tool, right, and accomplishing your overall goals. And sometimes that, like you said, that debt consolidation aspect of a refinance really helps cash flow. And and this topic came up because, well, we see it a lot, but earlier this week specifically, I get an email from a past client. Hey, John, my wife and I are now divorced. I need to get her off of the mortgage. What do I do? And that happened 3 days ago.
Yeah.
And so really we just touched on kind of what we need to do there. But the truth of the matter is there may be an option directly through the servicing company who's servicing that loan is really the first phone call. It's not necessarily the loan officer or the lender of a third party additional company that can give that guidance, because there's a lot that goes into that process. We're trying to remove someone off of a note that again has been securitized by 1,000 other mortgages.
Yeah, it's not as simple as just removing a name off a document.
Correct.
So when a name is getting put onto that contract for the note, a whole underwriting process happens. And we do a risk analysis of both people on there. When you take one person off, then the risk analysis is completely different, because now that person's income, assets, liabilities are all gone.
Yeah.
And so a new risk analysis needs to go through underwriting. And so that loan modification that you're talking about, that could be possible, the servicer's underwriting department, their loan modification department, actually handles it. So it's not going through the same channels. Hopefully it can be a streamlined process. But here's the hard part is, as a loan officer, we can't say if they're going to say yay or nay to it.
Right.
Because it's a bank's decision, a bank's underwriting department decision, and that loan officer is not involved in that anymore. The servicer now. And
that's true. And at the same time, we'd love to be that first phone call.
We could be an advocate for sure.
Because we'd love to understand exactly what you're trying to do. You touched on maybe a debt consolidation, maybe a cash out refinance, and sort of giving that guidance of, you're okay. You don't need to go through that process. That other spouse can go qualify for something. Here's how that works. And I think this is a good segue into, generally speaking, being a co-signer on a note of any kind, right? So, because I would kind of say at that point, after a divorce is finalized, it's almost like you're this sort of co-signer on an existing mortgage, but you're not paying that mortgage, right? And so you're not obligated on the note anymore, technically per the decree, but per the bank, you're still obligated. So that works also for auto loans. That works also for credit cards. And so one of the things we wanted to touch on, because we get this question a lot too, if we're ready to move to the auto loan
Let's
topic,
move on,
is what happens when you've co-signed for a cousin, a sibling, a parent on an auto loan or any kind of installment loan for that matter, but you're not actually making the payments. So someone else is making the payments, but you've co-signed on this note. And we see it occasionally. We'll pull credit, and there's 4 auto loans on a credit report, and it's just 2 people in the household.
Especially if it's parents doing it for their kids. We see that a lot.
We do.
But we also do see it for kids doing it for their parents who aren't working.
Yeah, kids for parents. I've seen cousins, I've seen siblings, co-sign. And so specifically how it works for an underwriting guideline is when we look at a credit report, you talked about qualifying based on your debts, qualifying based on your income. We're looking at what are you obligated on credit. And so when we see those initial installment loans, those initial car loans, we just make the presumption those are your car loans, right? So we're asking, okay, tell me, and then we hear, oh, I don't actually pay that car. My dad pays my car.
Right.
My cousin pays my car. Okay, so how do we show that on paper that you are not actually obligated for the mortgage liability, that car note is not on your ledger, on your expense ledger on a monthly basis.
6-month paper trail.
Yeah, or 12 sometimes.
Sometimes 12. Every guideline's a little different on the product. And also depends on how new it is.
Yeah.
It also depends on how old it is.
Yeah.
So if there's only a certain amount of remaining payments, was it 10 or less?
Fewer than 10 payments. Yeah,
So
10 or fewer payments.
If there's 10 or fewer payments left on that loan, we can exclude it because it's not going to have a continuance. If it's a newer loan, we just need to show from the inception of at least 6 months. So say it's they bought a car 7 months ago, we can show that all the payments have been made by that other person.
By the other person. So let's dive into
So that's
on
the paper
example.
trail.
Yeah, the paper trail. So dad's co-signed on my car, let's say, okay, and I'm applying for a mortgage. Dad's paying the car note, but we're both on there. Okay,
Right.
Dad's paying the note on a monthly basis. Let's just say it's a first-time buyer, and we've got a $400 car payment on credit, and that $400 car payment is really hindering the approval process, or at least for the amount that buyer wants to qualify for. It's nope, Dad's actually paying the car note. Okay, so here's what we need. We need possibly up to as many as 12 months of bank statements or proof of payments from the dad showing that car note is being paid. And here's the other kicker. It can't be a joint bank account.
Right.
It needs to be dad's account.
That's funny.
Because if it's a joint...
You're saying that even if your name's on that one too,
right.
then your name continues to follow the liability.
Exactly.
Yes.
So these are those nuances where, the two questions we get all the time: how much do I qualify for, and what's the rate? What's the payment? How much is it going to cost me? The how much do I qualify for question really depends on documentation supporting those debts and supporting that income.
Yeah, and we get it. In real life, you might not be the one paying the bills. A lender has to verify that. So even though that might be your real case, we still need the paper trail, because if it shows up on your credit report, then we have to prove that it's not your liability.
Yeah.
So.
Yeah, and I think it works for credit cards too. I mean,
credit cards.
So on a credit
those
report,
are hilarious at times.
Well,
because some people have no idea they're on credit cards sometimes.
No, I mean, my son. So I have a 17-year-old, and I think I put him as an authorized user on my American Express when he was like 13, right? 12 or 13. Wow. So he's had 4 or 5 years of credit
Authorized
building
user.
essentially as an authorized user. Now, the total bill comes out. I might put some business expenses on there, some branch expenses, some personal expenses. All of a sudden, there's a sizable balance. If I pulled my son's credit report, it's going to show that entire balance of my bill on his credit. Well, he's not obligated to pay that because he's an authorized user. But if he was applying for a mortgage, presuming he was 18 plus, which he's not there yet, but I'm going to be on him about buying a house as soon as he's got a job. Start building wealth. But that would show up. Let's just say it was a $3,000 balance. All of a sudden, he's got this $3,000 liability that he's technically an authorized user. So what we see more commonly is maybe two folks have split up. Let's go back to the divorce situation, and they were on a credit card together. And now they're divorced per the decree. Only one person's obligated on that credit card. The visa is not the spouse's responsibility. They're off the note. He or she is off that liability, but they're still on the card. So we pull credit, and now there's an $18,000 credit card with a $700 payment, and the person that we're doing the mortgage says, "Oh, that's my ex's card." Now what?
Now what? What do we do?
What
do we do? And it comes back to basically to
reviewing the decree.
Reviewing the decree to show that obligation is there, and sometimes we need a copy of the statement, like the monthly statement, to show where it's mailed to.
That's true. Mailing address.
So the mailing address is critical because that will tie who really gets it and who pays it. So those can get tricky.
Yeah.
A lot of times the alternative option, other than proving who's really paying it with a credit card, is get taken off the account.
Get taken off, as an authorized user.
And then we re-pull, a credit to show that you're no longer on there. So that could be another quick solution on a credit card, because that's a little bit trickier with an auto loan. You have to basically refinance the auto loan. But with a credit card, and if you're not buying within the next 2 or 3 weeks, this could be a good option, is to call that creditor. Since you're on their account, you can actually call yourself and ask yourself to be removed and ask them to report that to the credit agency that you're no longer on there. That piece is critical of knowing when they're going to do that. So you can actually ask the credit card company, now that I'm off the card that I'm requesting to get taken off of, when do you report to the credit bureaus?
That's right.
Because that will give us the date, and we'll wait, a day or two after to refresh the report.
That's right. And it might take 30 to 45 days, but it might take a week.
Yeah.
It could take a little longer. So an interesting scenario. Again, this just happened in the last couple of weeks on an authorized user situation on a credit card. So I pull credit for a married couple, and the lady has an authorized user account on her credit, and it's actually hurting her. There was a late payment on it. The balance was over the limit. It wasn't really consistent with the rest of her credit report, right? It's like this bad apple on the credit report. So I get the story behind it. She said, "Oh, that's my brother's account. I'm an authorized user on it." I said, "Oh, well, let's get you removed." Here's the catch. He's incarcerated. He's in prison. And can't get the authorized, and that was a case where she called the creditor, but they needed the account holder to call and verify. So again, is it the only thing that's hurting them, and preventing them from getting a mortgage? Not necessarily, but if we could get her removed from that card, it would raise her score. It would help their financial picture. It would maybe help them get approved. And so it could be the thing that prevents them from buying a house. That's crazy. So the bottom line is never co-sign for anybody. No, I'm kidding. That's not the bottom line. But bottom line is just be aware, be cognizant that when you are sort of entangled on a credit account with someone else, what that could mean for future purchases. And on the flip side, just because you're co-signed with someone else doesn't mean that you can't get a mortgage. It doesn't disqualify you.
And here's a pro tip. If you're going to buy a house, you can pull your own credit report ahead of time.
Yes, you can.
And you can see what shows up. And you will be surprised. I did that one last year, and all of a sudden I realized there was a Kohl's credit card that I did cancel that they showed as not canceled.
Oh, wow.
For 2 years.
Was it reporting like active?
Yes.
Oh, wow. Oh,
yeah, zero balance. Active.
But just active.
For 2 years.
Oh, my.
So that's weird.
Yeah.
And then I had there was a Capital One credit card that for some reason decided to continue to inquire my report every 7 days for
I remember
12 months straight. And that was annoying. It was a softball, but still.
And that's the thing, these
debt
creditors,
monitoring companies.
Yeah, that's the fine print. When you sign up for a credit card, when you take on a loan, and you scroll quickly all the way to the bottom of the 72-page agreement. I agree with the terms, all the garbage that's in there, all the legal jargon. Somewhere in there is probably authorization that you're giving that creditor to soft check your credit occasionally.
Occasionally, and occasionally can be every week.
And that's how they also monitor for credit line increases.
Yep.
But that's how they also, I've heard the opposite. I've had clients that had lines of credit that were getting shrunk, that were getting decreased because they were monitoring.
Over-leveraged.
And saw that scores had dropped, maybe late payments on other accounts, things like that. So the whole co-signer, I'm an authorized user, that is a little bit of a slippery slope, and we want to help you navigate through that, and just know that it's not going to disqualify you necessarily, but it can be one of those things that affects your purchase power.
Yeah, and what I hope people get is this is something you can work through with your lender's advice.
Yes.
And we can roadmap things for you to get those not counted, we call them excluded, so they're not hurting your liability. Now, if you want it to change your score, then you're going to have to do some credit improvement work, which means getting things taken off the reports with the creditors and then repolling. But I like this episode. I think, I want people to understand too, one of the things you said was great, was like, don't let it stop you from shopping. Right? So even though these things might be on there, that doesn't mean it's a stop for you. There are ways to work through them. Yeah, sometimes pretty quickly.
Well, and sometimes the process of going through, like getting removed from an account, sometimes it's necessary because of the payment obligation.
Right.
Sometimes it's necessary because of the credit impact. Sometimes it's both. And then other times, if you're an authorized user on a credit card the card's never been late or doesn't really have a balance on it, it's not really impacting your financial picture, then don't kick a sleeping dog. Like
Right.
just let it lie. There's no reason to take action, and that's the guidance that you're looking for. That's the guidance that we're giving you. Is that's not affecting you. Don't spend time, energy, effort, trying to fix something that isn't an issue.
Yeah, that's good. And I'm glad you brought that up. So we had a client a month ago, and we were going through their credit report, and there was a property that was listed as their liability, and so we got copies of our conversation turned into a couple other liabilities that were on there, of doing all this work to get this done is only really gonna make a minimal difference, like $5 to $10 a month possibly on your monthly payment. And they felt like that wasn't worth it. So we were just going to continue on because they were pre-approved as is. And so they're like, you know what, that is so much work. And the payoff doesn't equate that. So sometimes the path of least resistance just to get into the home, get the loan closed, is a better scenario than trying to clean up all this mess.
Yeah, if it does not affect the terms of your loan,
Right.
interest rate, closing costs, payment, cash to close, then let's not spend time, energy, and effort on trying to fix something that's not an issue.
And sometimes it feels like you're just reopening wounds.
Yeah.
The emotional cost is just too high.
Yeah, well, that's a good point. And then there's the flip side where, gosh, if we did this, whatever action we can take to remove an authorized user or get an account removed from your credit that you're not obligated on, and it affects your score enough points to improve your loan, improve your terms, I'm all for that. I love it. I think that's something that we're both passionate about is really looking at, again, what exactly is going on the credit report. And it's not necessarily what is the score, it's why the score is what it is. And sometimes it's because you're an authorized user on a $25,000 credit card that your ex had from 10 years ago, and you're still on that, didn't even know you were on it, right? And maybe it was dormant for a while and now it has activity. So there's so much in the picture of credit and this co-signer, authorized user piece of the puzzle. And so hope that brings to light today that something that we look for and we're aware of when we see a credit report. At the same time, we also want clients, if they're aware of it, if they know about it, bring it to our attention up front. Hey, I'm co-signer on this auto loan, but then also know that a really good lender should be bringing those things to your attention.
Yeah, one of the questions that you ask your clients, I've heard you ask because our desks are just doors apart from each other.
Yeah.
You'll say like, hey, we're going to be pulling your credit report. Is there anything you want me to know about before those come through? And you're basically asking like, what surprises or what do we need to put notes next to look into on your credit report that might not be obligated to you?
Absolutely.
And one of the questions we do love from borrowers, people that we're working with, is I've been asked the question like, okay, great, how do I make my situation better for the loan so I can get a better rate, right? And that's a great question because then we can go through, hey, here's like 4 pieces that you can choose to work. Like you're pre-approved now, but if you choose to work on these 4 pieces, we can get you into that next bracket of credit that's going to get you a better rate.
Yep.
And so those are great. And then that borrower can choose if they want to take those 4 things on or not, or maybe they take on 3, and we'll see where it goes.
And that guidance is so important because I think the perception of most clients is I'm going to wait. I'm going to take action on this account, or I'm going to wait till this account is paid down, this balance is paid down. I'm going to wait till I'm off the mortgage because I just got divorced and I want to make sure I'm off the mortgage before I do something. The truth of the matter is, by getting removed from an account, sometimes it can lower your score.
That's true.
And paying, like for example, paying off your auto loan, when you get to that last payment, those of you that are listening or watching and you've made your last auto loan payment, that's a good feeling. Do you know your score probably just dropped when you made that last payment?
Because of the history of
Because the account closed.
The account closed.
And part of your credit picture is an average of your current open outstanding credit lines, trade lines. So the average of length of credit. And so if you have
length of credit.
Yeah.
So if you've had that for 7 years and it goes away, that's a big hit.
All of a sudden it could shrink your average length of active credit, which can actually lower your score.
Most likely will lower.
Yeah, most likely. And so, folks aren't going to know that. You're going to think you paid your auto loan off. That's going to make my score go up, And so there's all these little nuances on the mortgage side that consumer debt affects what we do on the mortgage piece.
And that's good. And especially if you're within that last year of your car payment, like just save your money.
Yeah.
Make your monthly payments because we can exclude that anyway.
Yeah.
So I think that's a big one. People think that they have to have their perfect credit scenario up front without talking to a loan specialist. You want to talk to them first.
Yeah.
So that you can keep your cash to do the best things for you.
That's right.
Not just what you think you should do.
Yeah, it might make more sense to close on the home, then stroke a check for your car loan because you were going to pay it off anyway. Or you might actually need to pay the car loan in order to qualify for the loan.
Right.
Then what we do is we pay it off at closing. So your credit is not impacted until after you've purchased the home and after you've closed on the home.
Now wait, so you said something that we haven't really talked about much.
That's true.
This is what's done on the closing table. This could be a whole nother podcast because I'm excited about this all of a sudden. But when you have those debt obligations, explain this again because it's really good. When you have a debt obligation that can get paid at closing that has nothing to do with the house, and you're saying that actually might be your best scenario for you to not settle it, except for having title settle it for you.
Sure. Well, and so I'll give you an example. Let's say it's a $500 car payment, okay? And let's say that you have aspirations of paying it off anyway, or maybe you weren't going to pay it off, either way, but you've got this $500 car payment. What that equates to in the mortgage world is probably $60,000 to $75,000 of purchase price power.
Yeah.
So we get, again, coming back to the question, how much do I qualify for? Well, if we didn't have the car payment, you might qualify for $75,000 more house. Right now, you're qualified for $325,000. We pay the car off. We're now at $400,000.
Totally different house.
Totally different scope search, of houses, search criteria for your realtor, right? To go find the home that you want. So, to your question specifically, paying that debt off at closing, how does that impact versus paying it off ahead of time?
Yeah.
Well, let's unpack that real quick. So, you have this $500 car payment, and you decided, I'm okay paying off the car so I can qualify for a little more home, right? If you pay the car off prior to the closing and your credit is repulled, depending on the length of time, that car loan is now paid, closed. It could lower your score and hurt your mortgage, potentially, mortgage terms. Or we simply bring the money for the car. Let's say you owe $10,000 left on the car. You bring that to the closing table at the same time you're closing on the purchase of the mortgage. You add that to your cash to close of your house purchase. Now we're paying off the debt at closing, and that loan gets paid after the mortgage is closed, so your credit score is not impacted before closing.
I love it. And the other side of that, if you're selling your house and you're going to go buy another house, right? At the closing, you're getting a check cut to you of all your net proceeds from the sale of the home. You're so excited. You want to pay off your cars and buy your house. It most likely, 95% chance, it behooves you. We encourage you not to pay off those big car loans until after you close on your next home.
That's right. Pay them off on the purchase.
Because of the credit hit that's going to happen.
That's right.
Yeah.
The credit hit and the proof that we have to provide that you've actually paid those items. And so
because if we mark that those will be paid at your next closing, not your sale, but your buy, if we mark them that they'll be paid then, that document's requests are so much easier.
That's right, because the title company is handling the funds.
That's right.
The title company is handling the payoffs for those accounts. And we know that the title company is insuring that loan, so we trust and rely on the title company to make those payments versus if you make the payments, Mr. and Mrs. Consumer or Mr. and Mrs. Home Buyer, then those payments go through. We have to prove through the credit reporting agencies that those payments have gone through, they've cleared, there's zero balance. Holy cow, that's a whole nother
That's a podcast. I'm excited about this one.
Yeah,
just so people know, on our end as a lender, there's kind of three main boxes that we can check, when it comes to a liability line, right? You got, it's owed to you, and it's your monthly payment. But then you have excluded, and it still affects your score, but doesn't affect your liability line. So we don't count that cost every month that's coming out. And then we have a third box that's paid at closing. Mm-hmm. And that's what you're talking about.
Yeah.
And how that thing works out. We're going to have a whole nother podcast on this, I think.
Yeah.
Because paid at closing is one of our favorite things to do if that's the right scenario for the borrower. Sure. And I have heard horror stories of people that didn't know they had to do paid at closing, and they get surprised that, I have to come up with a lot more cash? So, we're gonna do a good podcast on that one, I think.
You bet. Cool. All right.
Well, I like how this has ended.
Same. Thank you for being with us.
Yeah.
Absolutely. It's a topic that can go so many different directions, as most of these topics can. And so we encourage you to reach out if you have questions, if you have debts and liabilities that you're not sure how they are impacting you. We'd love to explore it with you.
Yeah. Thank you so much for tuning into the Lending Podcast. Please like, subscribe, and share. Thank you so much.
Take care. We'll see you next time.
Bye.